Hello and welcome to FI for Kids, the show about guiding your kids on the path to financial independence and extraordinary lives. I'm your host, Dominic DeLaquil. Our guest today is Steve Selengut. Steve was a professional investment manager for over 40 years, actively managing portfolios for over 300 individuals. He's the author of Retirement Money Secrets, where he explains his road less traveled approach to financial independence, income-focused investing, wherein the goal is to safely produce spendable income in excess of the 4% rule and do it in such a way that you benefit whether the market is up or down. Definitely sounds intriguing, yeah? So let's get to it. Welcome, Steve, and thanks for coming on the show.
Well, thank you, Dominic, for that introduction, and I'm happy to be with you today.
We're going to discuss our fair share of technical details today, so before we get going, I want to say that none of our discussion should be taken as financial advice. This is information for education and to stimulate your thinking, and if you find the information intriguing, please continue your learning. You can get Steve's book, and don't hesitate to talk with a financial planning professional if you have more questions. So Steve, you developed a time-tested and safe methodology for income-focused investing that you maintain is the best approach for both growing wealth and is the best strategy for funding and supporting a life of financial independence. So let's just start there. Let's start with a basic explanation of what you mean by income-focused investing.
Okay. The income focus, I guess, replaces today's market value focus. And I mean today as this era of investing, not just today, particularly where everybody's kind of annoyed about their market value. What income focused, and maybe we could just, actually I can sum it up very easy with that illustration. Right now, investors are pulling their hair out because the market's been going down. To me, either one's an opportunity, but the thing is, they're really upset right now. You know, their 401ks are down 10%, this is down 10%. And the problem is that they don't really have any income coming in from their portfolios.
Right.
My portfolios, my personal portfolios now, because that's all I have. I sold my business almost 2 years ago. But judging from a Q&A I just had with my income investing community, everybody is still receiving their distributions from the securities they own. So even though the market has gone down, they're still receiving income, regularly scheduled income. But the key is, if you're making nothing on your investments, no income, and it goes down and you have something to spend it on, you have to sell securities at a loss possibly,
Right.
or at least at a lower market value than they were recently to make those expenses. If, on the other hand, you have a significant level of income coming in, the income pays for all your expenses. You program that. You don't have to invest every penny like Wall Street reinvests every penny. You hold aside a reserve for your expenses, and the rest of it goes into creating more income.
And now when you say a significant amount of income coming in, what you mean by that is income from your securities, right? From your stocks
Exactly.
or your funds. And we're going to talk about the type of funds that you recommend later,
Right.
but that's the income you're talking about. You're not talking about income from a job. It's from those.
Oh, no.
Yeah,
No.
from those funds
In fact,
or securities.
Yeah, this whole idea of income-focused investing really started way back when I was employed by an insurance company in New York City. And I was making a pretty meager sum of money, and I was fortunate enough to come into a bunch of money when I was 25, which is pretty young. And it was what people today would call a dividend stock portfolio. Everything paid dividends. And I got used to the idea of those dividends coming in early. And I also had a broker who, well, she was unique in that she wasn't not ever did she ever try to sell me the stock of the day or anything like that. What she did, she worked with what we had, and she said that you got to understand this stuff and what you have. You have a very high quality portfolio. It's paying dividends, but let's look at the way the market treats your GE, your so at the time, your Pepsi and your Coca-Cola. They go up and down. They go up and down. They go up and down. So between us, we developed this idea that since these are stable companies that have been around forever and probably will continue to be around forever, we could take advantage of those fluctuations in their price. We could set a target when we would sell them, 10% profit, and then we'd buy them back when they went down a little bit. And there were over 200 stocks at the time that paid dividends of a reasonable amount of money that made sense. And that's what we did. We developed this process, and we kept growing the income and growing the income and growing the income. And we started buying bonds. We started buying Ginnie Maes. We started buying corporate unit trusts that would pay us even more income. So we developed this portfolio that was income-based. It got to the point in a relatively brief period of time. In 1979, I was making 5 times my salary between the dividends. It wasn't a small portfolio at the time, okay? But I was making that much from the portfolio dividends and from the income on the other types of securities and on trading profits. 5 times. So I said, why am I running out and buying these 3-piece suits, getting all decked out so that I can walk up from the Port Authority building to 52nd Street and be a drudge at a desk for the rest of the day?
Yeah.
I don't want to do that anymore. So I did. So I said, okay, I'm out of here, basically. And I said, I'm going to teach other people how to do what I've done.
Yeah. So, and the key difference then is, instead of focusing on growing the market value of the stocks that you have in your 401k and your IRA and whatever mutual funds or ETFs you might have, instead of focusing on growing that market value that you're going to tap into later and then have to draw down, which is where you started, right? So drawing some of that down, that's the 4% rule. You live off of that 4% rule once you reach financial independence, and that should carry you through. And that's fine when the market's going up, because, right, it's going up more than 8%, and that covers you for the 4% you're withdrawing, plus inflation, and you're still growing money, and it all seems great until, right, you have times like we're in right now, and it makes everybody nervous. So, but what you're saying is not just sort of when you reached retirement, but this has been your strategy pretty much all along, is you focus on dividend paying securities, right? And we'll get into those details in a minute, but on having that, they're paying you an income, and then we're going to talk about the different things you do to continue to grow that. And you still take efforts to grow that portfolio. But one of the ways that you do that is you're taking that income that those stocks or funds are paying you, and then you're reinvesting it, right?
Right. Selectively.
Yeah. Okay. So let's talk about your 6 principles. So you have 6 principles that you use to approach this whole thing. And this is where, going back to sort of where I started, you've got a time tested, right? So obviously you've been doing this for over 40 years, and also safe, right? You've worked out how to do this in a way that minimizes risk. So I'm gonna summarize the 6 principles, and then you can go through them and explain them in detail, and should give people, I think, a good picture of sort of where you're coming from. And then we can talk more about how the ways in which this differs from the traditional investing of the day, as you put it. So your 6 principles for an income-focused investing strategy are quality, diversification, income, profit-taking, which I think you already referenced, understanding market cycles, and then assessing investment performance. So I'll turn it over to you, and you run from there.
Okay. I guess the difference we ought to look at just a hair before we get in there, is when you introduced the investing, you talked about IRAs, you talked about 401ks and things like that. When I developed this whole system, there were no IRAs or 401ks. So it was really just hard and fast stocks and bonds were it. You owned paper, and literally you could actually have the certificates, the stock certificates, if you wanted to, and the bonds themselves. Most of the principles you mentioned, many of your listeners are going to realize, are really principles that apply to all types of securities, not just to income-focused securities. I mean, quality, one of the measures of a quality stock is that it pays you a dividend, because it has to be profitable in order to do that. It has to respect the fact that you're an owner of that company, I don't know that most people who buy stocks and bonds in their 401ks even realize that they're actually owners of these
Right.
companies in a sense, or that they're loaning them money if they're buying bonds. But in any event, we used to measure quality in stocks by the dividend coming in, by the diversification of the company itself, how many different products it had, different lines of products and so forth, how many locations, was it global, all kinds of different measures of that. You even, you looked at the PE ratio and you looked at the debt to equity ratio, fundamental analysis, the fundamentals of this company, just like the fundamentals of a ball team or anything else. So you identified only securities that were quality, and we found like I said before, we had over 200 that met our quality requirements and that we traded actively. And even when I started my own business, the same companies, the same securities became my trading securities in that company. So that was the quality is always job one, just like at Ford, right? Then diversification is, I would say it's probably the principle of investing that most investors are aware of. The old "don't put all your eggs in one basket" thing that your parents always have told you, and things like that. But there are many ways to diversify and many things to look at. Again, it's a global economy. There are many different sectors. You don't want to have just healthcare stocks. You want to have some of those and energy and everything else you can. So you want to be broadly diversified. And that's by type of company, but you also want to be diversified by the amount you have invested in each thing.
Sure.
You don't want to have a large percentage of your portfolio in any one thing. Diversification can be of many types. And you have to make sure that not only are the securities you buy sort of diversified, but the portfolio you develop should be diversified. And that either stocks or bonds. Like if you're just doing a fixed income type, you want to have different maturities.
In the bonds.
Different types of stuff and things like that. So diversification is an important thing. The third thing, which I would say that if you asked most financial advisors or brokers, they would not include, is income development, income generation from the security itself. They're looking more for growth in market value than the income produced by the security. I consider it's just like it. And I'll eventually get to the analogy of how my portfolio is like my business. It is a business. It's like a department store, actually. But a business person wants to get income. He needs cash flow. And it always amazed me that Wall Street doesn't focus on that, since the key element of every company, every superstar company, every wannabe blue chip company, the thing they need the most of anything else is cash flow.
Yeah, absolutely. That's the
They
lifeblood,
got to pay
right?
their employees. They got to buy new buildings. They got to buy everything that has to do with their assets, whatever they have to do to produce what they produce or provide the services they provide. They need cash flow. They don't have it, they're out of business.
Yeah. Yep.
So why Wall Street doesn't emphasize cash flow to its clients, its customers, I could never understand. It was always important to me. It was important to my dad. Even he had income coming in from 3 or 4 different sources. I have income coming in from 3 or 4 different sources now, including my portfolio.
Right.
So, that's the way you want it to be. So income is paramount. It's one of the big four. And the final thing is also kind of ignored, and that's profit taking. Wall Street wants you to fall in love. Oh, we picked Microsoft for you. Aren't we good? Just watch how this thing just grows and grows and grows. It's just super. Of course, it doesn't pay any income at all. And I don't know how much it's fallen over this period where the market's down 10%, but you know that some of the bigs like Tesla, I understand, has probably gone down quite a bit.
Yeah.
And so on, more than 10%.
Yep.
So I always take profits, and I always set a target profit. And that target profit will vary according to what's going on in the marketplace or with interest rates, So, sometimes your target's as much as 5%. Sometimes your target's as much as, if I can take any target today, pal, I'm taking it. And that's how today was. Any profit is a good profit.
Okay.
Because then I can.
Sorry, go ahead.
then I can take that capital that I've produced and I can put it into something that I don't own that's at a lower price, or some of my other securities that have gone down in price, I can add to my positions. And I've prepared for that in my process.
Yeah.
What was
So
your question?
we'll talk about that in a second. So just to clarify, so what you're talking about then, and correct me if I'm wrong here, is that so let's say you own shares of QQQ, which is a tech stock, right? Sort of a broad tech stock. And so just
Right.
for anyone who doesn't understand, so when things like Tesla goes down, that'll drag that whole index down, right? That'll drag that ETF down because, it's a tech sector exchange traded fund, right? It's a tech sector fund. So what you'll do is, let's say you bought that 2 years ago when it was $350 a share. When you then set a target, and when it goes up to whatever percentage, let's say whatever percentage you set, when it gets up to, $450 or $500 a share, whatever the number is, you'll sell some percentage of those shares because you're going to make a profit from those, right? So rather than holding them forever and then watching them go up and down, like right now they're down, you would have sold at a target that you pre-identified, and then you take that money plus the profit that comes from selling those for more than what you paid for them, and then you reinvest that into other funds or other stocks that you've also identified, whether those are ones you already own that are currently lower. So you're like, hey, I can buy these at a bargain, even though I own some, or you'll invest into something you don't own that's also at a good price. And basically you're constantly repeating that process with the different securities and funds and individual stocks, whatever happens to be in your portfolio. Is that correct?
That's the concept, yes.
Yeah. I mean, and right, there's a lot of detail behind how to do that and how to do it smartly.
And which securities you use is a big difference.
Yeah,
but
of course.
That's the basic principle.
Okay, yeah, I just wanted to make that clear for everyone what that basic principle was. So I'm sorry, go ahead. So that was
you own these high quality things. You don't fall in love. You treat them like merchandise in a store.
Yeah.
Someone comes in, they want to pay your markup. You don't hassle with them. You sell it for the profit and you put something else on your shelves.
Oh, right. Okay. So that's your department store analogy. That's good. I like that.
Yeah. And you will eventually put that one back on your shelf as well.
Yeah, sure.
So yeah, that's the profit taking element of it. And it's very important. It's capitalism, for Pete's sake. I mean, that's what makes the world go round, is people doing things and taking profits, people providing services for a fee that makes it worth their while, greater than their expenses of running that business.
Well, that's what the department store is doing. That's what Microsoft is doing, selling their software products, right? Or their whatever services they're selling. That's what Levi's is doing with their jeans.
Tesla's doing. Sure.
Yeah, absolutely. Right. And so that goes back to what you were saying about you're managing your portfolio like it's a business, right? You're making a deliberate point, and you can talk more about these details, how you approach doing this, because it's all very systematic, right? Is that you're basically buying low and selling high and then repeating that process over and over again.
Right. I like to say lower and higher, but
yeah, okay, sure. Yeah.
The thing is, you don't want startup investors or something to think you can know when you're at the low or at the high.
Right. Well, okay, so let's talk about market cycles, because that's a really good point, because I'm glad you brought that up, because I think it is potentially misleading for people to think, hey, this is about timing the market, and that's not what you're doing at all. So why don't you go ahead then and explain market cycles?
Well, I guess the market cycle, all a person really has to go do is look back in time, and you'll see that there have been, since in my history, I started in 79 professionally. I went through the crash of 87. It went down further than it ever had before, and in just a matter, it led its way down from August to October, and then on my brother's birthday, it decided we're going to crash.
Yeah.
On
Black
October
Monday.
19th. Yeah, it just went down like crazy. Came back, year and a half. Everybody had forgotten all about that, so then we go a few more years. There was another small correction. Then we get to the dot-com bubble, where the no value rally is what was what it was called. The broadcasters would say, "We have no clue why these things are going up so high. They've never made a profit, but there they are." All of them. So at the same time, the companies like the Dow companies, which were paying dividends and were profitable and had long-term track records, they were all down. So at the end of the century, that reversed itself. The Nasdaq tanked, the other ones came back up again. Then we had, after that one was the Great Recession.
Yeah.
2008, same thing, went way, way down, came back up. They cut interest rates. Then, of course, we had 9/11 thrown in there. And then on the way to where we are now, we had the COVID crisis.
Yeah.
But every time it's up and down and up and down. If you look back over the charts, you could see the cycles of the stock market, of the bond market. The BND is the symbol you would use. And you'd see how much higher that was 5 years ago when interest rates were at zero. Just about. And now, how it's come down more as interest rates just went up recently.
Mm-hmm.
This is the market cycle. And you can always tell where you are. You don't know where you're going. You can know where you've been, where you are right now in any cycle. So yeah, we're down. But the whole thing happens over and over. It's a repetitive process. So you adjust your buying to where you are. I don't stop buying stocks when the market's at an all-time high. I just buy a smaller position because I know eventually it's going to go down and I'm going to add to my position.
Right. Okay. Sure.
So I'm buying stocks now. I'm adding to my positions.
Right.
So the same with the bond market and so on. So the market cycle is very, very important because it tells you, as long as you've done the other stuff, as long as you know you have high quality, you're diversified, the income's rolling in, and you're taking profits, then you can say, okay, I'm going to buy this stock regardless of its price now. Because if it goes down, I'm going to add to it. If it goes up to my target, I'm going to sell it. So I really don't care where it is. I don't care what's going in the market right now. Because I have full confidence that we will rebound from this correction just like we have from every other one.
Right.
And if we don't, the only thing that, what can happen where we wouldn't actually rebound? It would be total chaos. It would be like war, really bad stuff. Really bad stuff. And, I just can't imagine that again.
Yeah. Well, even then, those things have happened in the past over the history of the U.S. stock market. Yeah. And maybe things take longer to rebound, but they still rebound over the long haul. And in the meantime, right, and you can talk about this now or we can work it in later, because one of the main components of your strategy is that, well, and part of this you've already explained, you're not concerned whether the market, not that you're not concerned, you're not worried whether the market is up or down because you're taking advantage, you're making that work for you either way.
Well, I think what you were going to say is because throughout all of these ups and downs, the income is pretty much the same. The corporations rarely cut a dividend. And the bonds, they even more rarely do they ever default on a bond payment. So the reason this all works so well is because you're producing the income with which to take advantage of the market cycle.
Right. Oh no, that's a great way to put it. Right. So just to go back and recap a couple of those points. So you start by focusing on purchasing securities or funds, and we'll talk about those certain type of funds that produce income, right? And then you take that income from those, some of which you live off of, and the other part, right, you take and then you reinvest that to continue to grow your overall portfolio. The more you grow that overall portfolio, the more income you have coming in, because if your target income in percentage rate is 4% or 8% or 10%, whatever it might be, and you can talk about those in a second, how you do that, the larger the portfolio, the higher that number is. So that either gives you more to spend to do more stuff in your life, or if you're happy with your quality of life, then it lets you continue to grow that portfolio through the methods that you've just been discussing. Today's episode is sponsored by Venture Valley, a Singleton Foundation program. Venture Valley is an esports style video game. It's multiplayer. It's based around business creation, so it's fun to play and compete, but you also learn business and financial basics while you're playing. You can find Venture Valley at venturevalleygame.com. I'll put a link for that in the show notes. And thanks to Venture Valley and the Singleton Foundation for Financial Literacy and Entrepreneurship for sponsoring this episode. Before we get into talking about funds that are focused on providing income, I just want to take a quick second for anyone out there who doesn't have a good understanding of bonds and how they're different from stocks. I think most people from their 401ks understand stocks to one extent or another, although I think it is a good reminder that when you're investing in stocks, you're not just gambling, you're not gambling at all, you're investing in businesses, right? And those businesses have a vested interest in staying in business and doing a good job. And of course, some fail, but others succeed, some take off and go crazy. But overall, that's why the stock market always grows, because you're investing in businesses. You're an owner in those things.
And
so what are bonds?
The stock market, any stock of any corporation is always more risky than any bond or any other debt security of that same company. Because if a company gets in trouble, the first thing it's going to cut is its dividend. The last thing it's going to cut is it's not going to default on its loans that he's made to you as a bondholder. Yeah. Bonds are an evidence of a loan to the corporation. They promise you're giving them, you're paying for this bond, let's say $5,000. They're promising to give it back to you in 30 years, and every 6 months they're going to pay you the interest on it for that 6 months.
Yeah,
in a bond.
And so in the biggest sense, that's what a bond is. And then within that, there are different types of bonds. There are corporate bonds, like you mentioned. There are government bonds. There are municipal bonds. And there are also bonds, right? So you're essentially loaning them money. And there are also bonds of various different lengths, right? So not all are 30 years. Right. Some are 10 years. There's things in between.
Short.
What's that?
Some are very, very, very short term. Some are really only 30, 60 days, overnight almost paper.
Yeah. Yeah, and then there are also funds that so you don't have to just buy a government bond or put your $5,000 into one company bond that pays you a certain amount for 30 years. Right. A lot of what happens in 401ks, and you've got some sort of a mixed portfolio in there, is that you're investing in bond funds, because there are funds, exchange traded funds and mutual funds for bonds, just like there are for stocks, right? So BND that you mentioned earlier is like a whole bond. It's like VTI, right? It's like a whole bond fund that the managers of that fund buy lots of different types of bonds, right? So you're not worried about the particular $5,000 corporate bond that's for 30 years, because that's not what you're buying. You're buying little tiny pieces of a whole bunch of bond type products.
Exactly. Mutual funds were developed because it gave the individual investor access to the financial markets without the amount of risk of owning individual securities. And they've always been felt to be less risky than the individual securities. Okay? Then ETFs, they didn't come on board until the 90s, the 1990s. So they're the newest on the lot. I use a different kind of bond. It's called a closed-end fund, and it's not a mutual fund by any means. It's actually a trust vehicle, and it's a trust vehicle that is a pass-through trust. They must pass through to their owners, their shareholders, and they are owned like a stock. They have shares. They must pass through the shareholders 95% of their net income in order to keep their tax status. They don't pay any taxes because they passed it all through, and we pay the taxes. But they also do some other things that we could talk about or not that allows them to pay a very high rate of interest, higher rate than the securities they contain individually. And what they do is just like what other corporations do. I might as well clear it up. No mystery. A corporation gets its initial cash by hitting that bell on the New York Stock Exchange after it just went public, and it takes home, it gets the freight train full of cash, takes its billions of dollars back to headquarters
from its IPO.
And it starts from its IPO and starts to run its company. But what it also does, it goes to the bank and say, hey, look, we raised all this capital. We're doing this. Now we need to borrow money because we have to pay our employees because right now we're not making any money yet. But we have to pay them. So we have to borrow money, probably long-term debt, to do that. So they borrow money so that they can run their operation. Closed-end funds take that same, not as much, but some billions of dollars. They take all that money that they raised from their IPO and they invest it in bonds if they're a bond fund, the stock market if they're a stock market fund. Okay? And they invest in that. And by the way, it's the very same stocks that you and I buy if we were going on the stock exchange. So in one of these funds, you probably own every stock you ever thought of owning.
Right.
In one of these closed-end funds. So they'll buy those and they'll do the same thing. Not because they have to pay anybody, but because they can borrow short-term money. Back in 5 years ago when interest rates were near zero, did you borrow any money to do something with? Did you buy a car?
Yeah, actually we did.
Did you buy a home? Did you get your mortgage down to 2% or
we did
3%?
Get our mortgage down low, and then we did a refinance, took some money out to keep our house payment the same to redo the kitchen, right? So we kept everything, which worked out great when interest rates were really low.
I took a HELOC. I took a $150,000 HELOC, and I got it at something like 2.5%, and I invested it in these closed-end funds.
Sure. Well, and the reason being, okay, so let's talk about
because closed-end funds were yielding.
Yes, because most people think, right, okay, well, all right, I can get, a 3.5% yield from these bonds, and some mutual funds or some stocks will pay 2 or 3% dividends. The closed-end funds, you can find closed-end funds that are paying 8, 9, 10, 12%.
Right now, the average is over 10%. I have over 200, the equity and taxable income bonds. Over 200 different bonds. Their average yield is 10.6%.
Yeah.
Average yield.
That's crazy. So then so the math is at 10%, you're paying 2.5% on that HELOC. So then you're still making 7.5% on that 150 that you took out against your home when interest rates.
Exactly.
For mortgages, right, we're super low.
Now, the downside of a HELOC is that it's variable rate.
Yeah, sure.
So you have to know that you have the power that if the rate starts to go up, that you can pay it off.
Yeah.
So I was comfortable. That's why my wife only allowed me to go to 150.
Sure. Yeah.
But that's what the closed-end fund does. Not only does it have the assets that are producing money that bought with our initial investment, it also has probably as much as 35% more that it's borrowed money because it knows it can reinvest it at a rate higher than what it was paying. And so that margin becomes profit, and that's how that works and lets them pay so much.
And they're obligated to pay 95% of what they make back to their shareholders.
Right.
In order to maintain their tax status, you're saying.
Right.
Yeah.
And they can only take the limit on the leverage that they use, the borrowing that they do is 50%. Rarely do you see them that are much over 35.
Okay.
So that's one of the reasons they pay so much. But they also trade just like stocks, and they operate just like stocks. So their prices are dependent on supply and demand. Both mutual funds and ETFs manipulate their prices by adding securities or taking them away to make their prices equal to the net asset value of the fund.
I see. Okay.
And closed-end funds don't do that. So the net asset value is really kind of meaningless because it's really a function of what the market price is of the securities they own anyway. It's not a function of the management.
Yeah.
So these things are what I use, and they've been around longer than any of the other funds. They were developed in the early 1800s, and many of them have been in operation for 100 years.
Yeah. So this isn't some newfangled.
Not a new thing at all. The average age in my portfolios is over 20 years.
Yeah.
that they've
Okay.
been around.
Well, and in your book, you talk about, I'm just going to call it 3 different flavors of mutual or of closed-end funds, right? So you've got ones that are more focused on growth. Tell me if I'm getting this wrong. Ones that are sort of a hybrid, and then ones that are more focused on income producing. And they're all producing income, but the focus is a little bit different. So talk about those 3 things for a second. Because that all plays into also sectors and what type of securities are held within those funds. I mean, all this sort of stuff we were talking about earlier in terms of diversification, that all plays into this. So talk about kind of growth focused, hybrids, and then income.
I consider the growth focused the ones that have at least 35% invested in the stock market. So I might have some hybrid funds in my equity portfolio. Some of them may own a good percentage of other types of securities in there, but if they have more than 35% in the stock market, I consider them growth securities. And they, like I said, they own every stock you can conceive of. There are some of them that own thousands, so you must know they own some small cap NASDAQ companies as well as the S&P 500 and the Dow 40 or 30 and the FANGs and all the big name stocks. So you're really in the stock market, but in a much safer container because it's a managed portfolio. If Tesla actually goes to zero or Nvidia, you're not going to feel any pain because it's only this much of the fund that you own. So you're diversified. It's producing income. The quality is a known commodity. You can see how it's paid its distributions over the years. You can see how its portfolio has gone in a pretty narrow range most of the time, but following the stock market. I mean, you see that same. Remember we talked about the Great Recession dip and everything. Mm-hmm. It's in those things too.
Sure.
You know, but in the meantime, it's paying all this money. The problem with it from a market value focus is think about a company. Think about any of our companies. If they had to pay out 95% of their earnings to their shareholders, would they have become $1,000 stocks? Would they have become as big and wonderful as they are? No, they wouldn't have been able to grow.
Right. Right.
So the closed-end fund, because of its high income and low propensity for gaining great market value, momentum, and all that stuff, makes it much less sexy for professional investment managers to go near.
Sure.
Because they get paid. I used to get paid on market value. I didn't get paid on how much income I was making for my clients.
Right.
My clients loved me for that. And I never got a phone call during a correction.
Yeah, because you were focused on you were working with them on income focused investing.
And they knew that's what I was all about. They knew it's about the income.
Yeah. Interesting. So you touched on kind of on closed-end funds that are growth oriented. So hybrid obviously will be a mix of the two. So on the other end, you've got more income focused closed-end funds, and do those typically have more bond type securities in their portfolio? How do they differ from growth oriented ones?
Absolutely. Well, they have less than 25% of stocks if they have any at all. Mm-hmm. But they'll have corporate bonds. They'll have some they call themselves intermediate length bonds, or long-term. Different quality levels of bonds, big cap. Global. They might have a global orientation. And you can check inside and see where they are.
Yeah.
They'll have preferred stocks. They'll have income real estate. They'll have mortgages. They'll have...
They might have REITs in there then too?
Yes.
Yeah.
Some of them will have REITs.
Okay.
Some of them will have master limited partnerships. Some of them will have CLOs, collateralized loan obligations. And I think I only have one, maybe two, that has any BDCs in it.
What's a BDC?
A business development corporation.
Okay.
It's another popular form of income security. I think it's quite risky. So that's the income ones. And then there's also in the income area are the municipal bond closed-end funds. And believe it or not, yield on my universe of tax-free municipal bonds right now is almost 7%.
Wow. Now, when you say
6.77.
tax-free, does that mean tax-free for you?
Tax-free for you.
Yeah. A tax-free municipal bond, that's what that means?
Yeah, it's a portfolio of tax-free municipal bonds. There are some most of them are all over the country,
Mm-hmm.
but there are Pennsylvania, New York, New Jersey, Massachusetts, Minnesota bonds today, CEFs of municipal bonds in those states today, which are tax-free or state tax-free as well as federally tax-free at over 7%
Wow.
that are available.
Yeah. Yeah. So, right, I mean, you can see how someone who's at the point of financial independence, at whatever age that they might be, how this would make a lot of sense for them. Because now you're not concerned about drawing down that portfolio and hoping it's going to last, right? You're managing it in such a way that you've got enough income to cover your living expenses, and anything beyond that, and any of the profit taking that you do in reinvesting, buying lower,
Right.
selling higher, just helps grow that portfolio. But you're able to live off of this indefinitely, right? Because you're
Right.
generating more than what you're spending. Let's assume that you're still living, you're spending money for your life, a life that you enjoy, doing things that are meaningful to you at, still according to the 4% rule. Or even if you bump that up a little bit and do 5%, you're making more than that just from the income from, let's say, just from closed-end funds, if you're doing this smartly.
Absolutely.
Yeah.
Go
ahead.
Just the same. Like, for example, my IRAs, my wife's and my IRAs, we've been paying RMD on them for almost 8 years. Never had to sell anything to do that. The income from the IRAs is more than double the RMD.
Yeah.
The income on our personal accounts is just so much that I pay for these trips that I take.
Yeah.
Are totally paid from income, not from
drawing down any of your portfolio. And just to be clear, so the RMD, that's the required mandatory distribution. So once you reach a certain age, then for
me it was 72.
Yeah, then you've
now
got
I think it's now 73.
Okay.
Keep moving it up.
Yeah.
Eventually they'll get rid of that rule.
Mm-hmm.
I doubt that I'll experience, but
Well, but it doesn't matter, right? I mean, it matters, of course. Like, you're still having to do it and pay that because you're not taking it, but you're making more than what it takes to do that, so you're in a great position.
Yeah.
So that leads me to where I wanted to go, right? What I want to do is I want to come back around to, and as we wrap things up, discuss how this is relevant for people that are younger, right? Because this is FI, financial independence for kids. And I think, so we've been talking a lot about kind of the basic nuts and bolts of this approach to investing. And what I don't want to do is leave it with, well, this is great for people that are already at retirement. And that's not the case, because this has been your strategy all along. This is how you built your wealth. Right. And it's also, if I remember right from when we talked before, this is the approach you took with your kids. So this is an approach that you can use at any age, correct?
You can use it at any age. Your kids, I started at 25, and I've been fortunate enough that it's large enough that I could take care of my kids' educations and my grandkids' educations as well. So they didn't have to do that.
So you use this strategy to basically pay for your kids and your grandkids' educations, is what you're saying.
Yeah.
Yeah.
Yep. Yeah, my granddaughter just graduated this year. So she was the last. I only had 2, so it wasn't a big deal.
Yeah.
And I only had 2 kids either. I know people who have 5 and 6 kids, and if I had that, I would have been pulling my hair out too. But the point is that you can't start income focusing too young. The sooner you see that your IRA is making as much money on its own as you're allowed to contribute to it, the light bulb starts to shine. You see the work it's doing, that you're not like when I was making all that money initially, and I was making more than I was making in my job. That that resonates and says, okay, I've got a sense of freedom here. I can pretty much do what I want. I can tell my boss, no, I disagree with you, and take that risk of having the audacity to say such a thing because I didn't care.
Well, no, right. That's the whole point of reaching financial independence.
Exactly.
Whatever route you take to get there, one of the whole points is the freedom that it provides and the opportunities that then it provides you, right? So if you still like that work and you want to keep doing that, but something shifts within that organization and you're like, this doesn't fit me anymore, you can feel perfectly comfortable walking away. And if you then decide, you know what? I really like doing that, but I'm going to take a break for a while, and I'm going to now, you know what? I always have had an interest in art or music or whatever the heck it was. I'm going to do that because I'm not trying to make a living from being a writer. I'm doing it because I want to do it. And if something comes of it, great. If not, I don't need it because I'm financially independent. That's the whole point.
I had a coaching client recently who took a whole 8 months off to take his daughters, he and his wife took his daughters a trip around the world, basically. Yeah. They just took off for 8 or 9 months because he could.
Because he could.
Because he converted his portfolio to income. He didn't dip into it a cent.
Yeah. Oh man, that's
just financial independence is certainly a thing to shoot for. But within your financial independence, you have to have income independence. They're not the same.
Yeah. Okay, good. Great point. Great point. Income independence. I like that, Steve. So as we wrap up, so we've talked about kind of the basic idea here, and I just want to put out there's a lot more detail to your strategy behind this, and we're not going to try and cover all that today or on the podcast. But I think you cover that very well in your book, Retirement Money Secrets, which I strongly recommend to everyone. If you're interested in knowing more about how this works, no, great. There it is.
There it is.
Yeah. And, it's told from the point of view of a story. It's a narrative story, a conversation that you're having with some people you met on vacation. And then you take that conversation to sort of explain a lot of what we talked about today, but then go into more detail and all about the very specific approach that you take. And so it really, Steve, I want to compliment you. You did a great job because you've got a ton of detail in there, but the way that you put it together, it has a nice narrative flow and it's not this dry, like, oh my gosh, it's not a slog at all because it's like a story and you're having a conversation with these people, but you still get all this technical information in there. So if anyone wants to know more about income-focused investing and closed-end funds, I highly recommend Steve's book because it explains all of that stuff in great detail. So I'll put a link for that in the show notes, but also where can people find you and are there any other resources that you would want to recommend?
My website is theincomecoach.net and I have a community that they'll find out about in the book where they can actually get full education in addition to the book in the form of Q&As and all the selection universes I have is made available to them and just, a library of old articles and new articles and stuff like that. And conversations that just go on and on and on. I spend most of my day participating in conversations within the community members. It's really very active.
Great. So as people are learning and they have questions and they want to, so almost like your own community of almost a Reddit where people are asking questions and then, right, and you're answering questions. Are other people able to sort of communicate with each other then, I'm assuming also?
Sure.
Yeah. No, that's great. And when you say your selection universes, that's your selection universes. That's what you use to pick closed-end funds that you're going to invest in. Is that correct?
For my own portfolios, yeah.
Yeah.
And people can use that as a reference source, and then they can go out and study and look and research all they want.
Yeah. Great. I'll put links for all those things in the show notes so people can just click on those. So any final thoughts, Steve?
No.
Well,
we're good. I enjoyed the conversation. I think we covered pretty much all the bases.
Yeah, I hope we got the basics out there just to give people enough to be like, oh, that sounds, like I said up front, that sounds intriguing. I want to know more, right? Because that's what I got from you. It's like, you're like, have you ever heard of closed-end funds? I'm like, no, but now I do, and I've invested some money in those. So
Really? I'm glad to hear.
Yeah. So anyway, I think it's great stuff, and I really appreciate you coming on. And I know you've got a European vacation coming up soon, so have a great time.
I will. It's not long away. It's only 3 weeks away.
Yeah. Okay. Thank you for listening to this episode of the FI for Kids podcast. Please support the show by hitting subscribe and receive new episodes every Thursday. The intro and exit music this episode are courtesy of Douglas Cameron. As always, you can find links to the FI for Kids music in the show notes. Thanks again, and we'll talk next week.
Feel like the horizon, I can't reach you, you're so far away. And if I run to the place I want you to stay, you'd be gone. I've been left wondering why you moved on, and why you never said goodbye. I can't wait any longer. I see the writing on the wall. It's time for us to say, tomorrow we are yesterday. Tomorrow we are yesterday. You're like the sunset, you're glowing